Long-term assets, property, plant, and equipment, types, cost, depreciation, and disposal. These are some of the issues we're going to be talking about. First, let's learn about the characteristics of long-term assets. Plant assets are tangible, meaning they can be touched. They're used in a company's operations. They have a useful life of more than one accounting period. They're often called fixed assets. For many companies, these plant assets make up the single largest class of the assets they own. They're set apart from other assets by two important features. Number one, they're used in operations. This makes them different from, for instance, inventory that is held for sale and not used in operations. The distinctive feature here is the use, not the type of asset. For example, a company that purchases a computer to resell it reports it on the balance sheet as inventory. If the same company purchases this computer to use in operations, it is a plant asset. The second important feature is that plant assets have useful lives extending over more than one accounting period. This makes the plant asset long-term and not a current asset, such as supplies that are normally consumed in a short period of time after they're placed in use. Accounting for plant assets reflects these two important features. Since plant assets are used in operations, companies match their cost against the revenues they generate in a systematic and rational manner by depreciating the asset and this rational allocation is called depreciation. Since their useful lives extend over more than one period, our matching of cost and revenue must extend over several periods. The journal entry is to debit depreciation expense and to credit accumulated depreciation. An important exception is land. Land cost is not allocated to expense as land is expected to have an indefinite life. Let's talk about the asset types: land, land improvements, buildings, machinery, and equipment. And there are also three major issues surrounding these types of assets. First of all, we want to compute the cost. It's more than just simply the purchase price. Additionally, we want to learn more about depreciation. And thirdly, we want to learn about recording the disposal of plant assets. Let's talk first about computing costs. Plant assets are recorded at cost when acquired in accordance with the historical cost principle. This cost includes all normal and reasonable expenditures necessary to get the asset in place and ready for its intended use. So this extends beyond just simply the purchase price. We need to look at other costs that surround placing the asset into use. The cost of a machine, for example, includes its invoice costs plus any required freight, unpacking, assembling, installing, and testing costs. Example of the costs of building a base or a foundation for a machine and providing electrical hookups. To be recorded as part of the cost of a plant asset, an expenditure must be normal, reasonable, and necessary in placing it and preparing it for its intended use. Focus on this when trying to determine what costs should be added to an asset. If an asset is damaged during installation, the repairs are not added to its cost. The repairs are charged to expense. Another example would be if you pay a fine for moving heavy machinery without a proper permit, it would not be considered part of the machinery's cost. But if beforehand you pay for the proper permit, it would be included in the cost of the machinery. Charges are sometimes incurred to modify or customize a new plant asset. These charges are added to the asset's cost. Land. When land is purchased for a building site, its costs include the total amount paid for the land, including any real estate commission, title insurance fees, and legal fees. Additionally, there may be accrued property taxes which will have to be paid by the purchaser. There may be payments for surveying the land, clearing the land, grading, or draining the land. Additionally, there may be government assessments, whether incurred at the time of the purchase or later, for items such as public roadways, sewers, and sidewalks added to the land in order for the public to be able to access the land. These assessments are included because they permanently add to the land's value. Land purchased as a building site for a future building sometimes includes structures that must be removed. In order to calculate the cost of the land, you will want to add the cost of the removal because it adds to the cost of what it takes to get the land ready for its use, but you would want to subtract any salvage proceeds. Let's look at an example. A company pays $180,000 cash to acquire land for a retail store. This land had an old structure on it that was removed at a cost of $10,000. However, the company obtained salvage proceeds of $3,000 from selling components of the old structure. There were closing costs of $9,800. Therefore, the total cost of the land would include the cash price, the removal of the old structure, subtracting out the salvage proceeds, adding the cost of the closing, and then the total land cost would be $196,800. Next, let's look at land improvements. Land has an indefinite value and is not used up over time. However, land improvements have a limited life, and they include such items as parking lot services, driveways, fences, shrubs, and lighting systems. These will need to be depreciated, so they need to be separated from the land. The cost of these improvements increase the usefulness of the land, but they are recorded in a general ledger in a separate land improvement account so that their costs can be depreciated in accordance with the future periods they benefit. This expense is matched to the revenues earned during these periods as these assets were put into place to help the company earn revenue. Buildings. A building account is charged for the cost of purchasing or constructing a building that is used in operations. When purchased, a building's costs usually include all the necessary and reasonable costs to procure the building, including the purchase price, brokerage fees, title fees, attorney's fees, and any other expenditure necessary to get it ready for its intended use, and any necessary repairs or renovations such as wiring, lighting, and flooring. Machinery and equipment, their costs. These would consist of all costs normal and necessary to purchase them and prepare them for their intended use, including the purchase price, tariffs, transportation charges, in-transit insurance, installing, assembling, and testing the machinery and equipment. Now, what happens if there's a lump sum purchase, if you purchase land, building, and an equipment? Sometimes plant assets are purchased as a group in a single transaction for a lump sum price. The land structure and land improvements already exist and are purchased together, but need to be separately recorded in the general ledger for purposes of depreciation and to provide useful information on the financial statements. So, in order to allocate the asset costs in the general ledger when there's a single price, we follow these steps. First, we want to obtain the appraised tax value or market value of each type of asset. These are they. So this was the market or appraised value of the land improvements, and the building. So we can see that the market value of the land or the appraised value was $200,000. However, the company was able to only pay $180,000 for the land improvements, and buildings. So we need to allocate these the $180,000 amongst all three types of assets. Second, we want to add all of those assets, the values together, the appraised values of the property, and so that was $200,000. And then we want to calculate the percentage of each asset class as a portion of the total from step 2. So the land was $100,000 out of the $200,000, the land improvements $30,000 out of the $200,000, and the building was $70,000 out of the $200,000. So the percentage of each of these would be 50% for the land, 15% for the improvements, and 35% for the building. So in order to allocate, we want to multiply the single price of $180,000 by these percentages, single price paid, then the amount that will be recorded in the general ledger will be $180,000 for land times 50% or $90,000. $27,000 for land improvements, which is $180,000 times 15%, and then $63,000 for the building, which is $180,000 times 35%. Depreciation. This is our next topic. Depreciation is the process of systematically and rationally allocating the cost of the plant asset to expense in the accounting periods that will benefit from its use. The assets were placed into service in order to help the company generate revenue, and their costs must be matched to the revenue they help to generate. Depreciation does not measure the decline in an asset's market value each period, nor does it measure the asset's physical deterioration. Let's look at the factors we will need to consider in computing depreciation. First, we want to look at the cost. Secondly, we want to look at the salvage value. And third, we want to look at the useful life. Note, salvage value and useful life are estimates. So cost minus salvage value yields our depreciation base. Salvage value is an estimate of the asset's value at the end of its benefit period. Useful life is the length of time it is productively used in a company's operations. So, for example, the productive life of a computer can be 8 years or more. Some companies, however, trade in old computers for new ones every 2 years. In this case, the computers would have a 2-year useful life. Now, let's look at the depreciation methods. Depreciation methods are used to allocate the plant's assets cost over the accounting periods in its useful life. There are 3 different methods we're going to learn about. The first one is straight line, which is the most frequently used. The second is called the units of production method, and it is used when assets are infrequently in use. The third is double declining balance, and it's a method often used for tax purposes. We'll use the following consistent example to understand how to calculate depreciation for these 3 methods. So our asset costs $10,000, its salvage value is $1,000, the depreciable base is $9,000, our useful life is 60 months or 5 years, and in calculating straight line depreciation, we will always use the number of months because machines are not always placed in service in early January, so we may have partial year depreciation. And then in order to calculate units of production, we will want to look at the total units to be produced from the machine. So straight line. The straight line method of depreciation charges the same amount of expense to each period in the asset's useful life. So first we want to determine the depreciable base, which is cost minus salvage value. Then we want to divide the depreciable base by the number of months in the useful life, and then multiply this product by the number of months associated with the counting period. So let's look at 2 examples. If the machine were placed in service on January 1 and we're preparing financial statements as of December 31st, then our cost minus salvage, our depreciable base is $9,000. We want to divide it by 60, which is the total number of months in 5 years. So the depreciation per month is $150, and we want to multiply by the number of months that we're going to have it in service this year, which would be 12, and that's going to give us $180,000 as the value of our journal entry. So depreciation expense will be debited, accumulated depreciation expense credited. The reason why I advocate using months is because there could be a partial year depreciation calculation that we will want to do, and I don't want to teach 2 different methods, one to use for yearly depreciation and another one to use for monthly depreciation. So I want to be consistent in our presentation, so we're going to use months. Now let's look at our second example when we are going to have a partial year depreciation. In this instance, the machine was placed on service on July 1st. Make certain that you look at the number of months and not just simply take the fact that we're preparing December 31st financial statements and assume this is 12 and then subtract 7 and assume that that's 5 months. Actually, it's 6 months, so you have to take into consideration July, August, September, October, November, and December. So those are 6 months. So make certain that you take that into consideration. Depreciable base is $9,000. Number of months is 60, $150 a month. A number of months for this accounting period is 6 months. So our depreciation in this instance is $900. In our first example, the $1,800 of depreciation expense is reported on the income statement among the operating assets, and the $1,800 of accumulated depreciation in our journal entry up here is a contra asset account to the machinery account in the balance sheet. So the contra asset account accumulated depreciation is associated with the machinery account in the balance sheet. Next, we want to look at a concept called net book value. This is a very important concept. Net book value is the asset book value or simply book value and is computed as the asset's total cost less its accumulated depreciation. Do not confuse the calculation of book value with depreciable base. They do look similar. So this is the calculation of depreciable base. Same information, but now we're looking at it in relationship to accumulated depreciation, and we're looking at book value. Book value will be important in several different concepts we're going to be looking at in the rest of this lecture. Continued example of book value. At the end of year two, the book value is 6,400 and is reported on the balance sheet as follows. So the first year, the book value was 8,200. The second year, after 2 years of depreciation, is 3,600. So the book value would be 6,400. The book value of this machine declines by $1,800 each year due to depreciation. It's important to know the concept of book value and accumulated depreciation when we calculate gains or loss on the disposal of property, plant, and equipment. And also, it will be important when we calculate double declining balance depreciation. So let's look at the book value at the end of year three after we've depreciated it for 3 full years, book value at the end of year four, and book value at the end of year five. Now, an important thing to notice here is the net book value after it's been fully depreciated is salvage value. So the book value will always come down to salvage value. Next, let's look at the units of production method. The use of some plant assets varies greatly from one period to the next based upon usage of the machine. It may be idle for a portion of the year. A builder, for instance, may use a piece of construction equipment for a month and then not use it again for several months. When equipment use varies from period to period, the units of production method can better match expense with revenues. Units of production depreciation charges a varying amount. So straight line is the same amount of expense each period. Units of production uses a varying amount for each period depending upon its usage. So here we see that we're going to calculate the depreciable base just like we did for straight line. In our example, we said the machine was going to be able to produce 36,000 miles. So we're going to look at the depreciable base and divide it by the total number of miles we expect to get out of the machine over 5 years. And so for each mile, we're going to assume that the depreciation is going to be 25 cents. So in the first year, we drove it 7,000 miles. So in year one, the depreciation would be 1,750. In year two, we're going to drive it 8,000 miles, so the depreciation would be 25 cents times 8,000 miles, or $2,000. Then in the next year, it's 9,000 miles we drive, 25 cents times 9,000, 2,250. Example, same thing for the fourth year, same thing for the fifth year, till we come up to our total depreciation of 9,000. Again, our cost was 10,000. If we come totally depreciate it down to from by not to 9,000, then 10,000 minus 9,000 would give us a net book value at the end of 5 years of $1,000, which should equal always salvage value. So let's look at this. Net book value, net book value, net book value based upon each year that we've depreciated it, and again, varying amounts because it's units of production based upon the production that is used in each one of these years. And then ending book value is salvage value, and that makes sense because we have we've calculated depreciation on the assumption that we were going to depreciate $9,000. Next, let's look at the double declining balance method. This is an accelerated depreciation method which yields larger depreciation expense in the early years of an asset's life and less depreciation in the later years. It's often chosen for tax purposes. So how do we calculate it? The rate is calculated as 100% divided by the useful life in years. This result is multiplied by 2 to obtain the double declining balance rate. So let's look at that. So we always take 100%. We're going to divide it by the years of the asset's useful life. And in this instance, every time we calculate it for both homework as well as your test, it'll always be on the useful life in years. Then that yields 20%, which is called the straight line. Then we'll multiply that by 2, and that'll give us the double declining balance rate. Now, how do we calculate it? The rate is then applied to book value. So it's applied to book value, not the depreciable base, for each year. In the first year, the book value equals the asset cost because accumulated depreciation is not yet recorded. So let's look at the book value in the first year is $10,000 times 40%. So our accumulated depreciation and depreciation expense in the first year is going to be $4,000. So in order to obtain book value in the second year, we're going to take the cost minus the accumulated depreciation of 4,000. Then our book value will be 6,000. We'll multiply that by 40%, then that yields 2,400. So then we're going to take the beginning book value, subtract out this new accumulated depreciation, and come up with the end of the year 3 book value. Multiply that by 40%. We're going to repeat the same process. We'll come down to an ending book value from which we want to subtract the salvage value, and that will give us the depreciation expense in the last year. In your tests as well as your homework, we will not be fully depreciating an asset using double declining balance into the last year. I've included this here so you'll have a comprehensive example, but I just want to let you know that we won't be going much further beyond year 2 or 3 as far as the calculations are concerned. Next, let's look at a change in an estimate for depreciation. Depreciation is based on estimates of salvage value and useful life. During the useful life of an asset, these estimates can change. Use the new estimate to compute depreciation for current and future periods. So let's look at an example. At the beginning of an asset's third year, its book value is $6,400, which is computed as $10,000 minus $3,600. Assume at the beginning of its third year, or alternatively, you can describe it as the end of the second year. So pay particular attention to a test and homework question when they use these terms, because they are used interchangeably. Now, after the end of the third year, the estimated number of years that remains in its useful life has changed from 3 to 4 years. So they were expecting to get 3 years out of the machine, but now they see that they can get 4 years. And its estimated salvage value changes from $1,000 to $400 because they're going to have it in use longer. Straight line depreciation for the remaining 4 years will be computed as. So a note here also that all homework and test questions will be based upon yearly depreciation. Again, we're only going to be using partial year for straight line depreciation. Okay, book value at the time of the revision is $6,400. From that, we want to subtract salvage. So in this instance, we had a revised salvage. However, if the salvage is not revised, use the original salvage. So in this instance, it was revised, so our new depreciable base is 6,000. Next, we want to divide that by the revised useful life. If the useful life has not been revised, then we want to use the original life. This gives us a new yearly depreciation of 1,500. Revising an estimate of the useful life or salvage value of a plant asset is referred to as a change in accounting estimate and is reflected in the current and future financial periods, but it will not be reflected in prior financial statements. So let's look at what the effects of reporting accumulated depreciation is. And I guess I should have finished that, but anyway. Okay, so both the cost and accumulated depreciation of plant assets are reported on the balance sheet or in its notes. Reporting both the cost and accumulated depreciation of plant assets help users compare the assets of different companies. So how does that work? For example, a company holding assets costing $15,000 with an accumulated depreciation of $40,000 is likely in a situation different from a company with new assets costing $10,000. So let's look at this. This is a company with older assets, $50,000, accumulated depreciation is 40,000 and its book value is 10,000. This other company has new assets of 10,000. No depreciation has been recorded yet. So notice it also has a book value of 10,000. Now, if the book value was shown on the financial statements without the accumulated depreciation, you wouldn't be able to tell that this company had older assets and this company had newer assets. While the book value of 10,000 is the same in both cases, the first company is facing the need to replace its older assets. These insights are not provided if the two balance sheets only reported the $10,000 book value. Now let's look at discarding of plant assets. Disposal of plant assets occur in one of three basic ways. We can either discard them, just simply throw them out, we can sell them or exchange them. We will cover in this class discarding an asset and selling an asset. So let's first look at asset discarding, the journal entry steps. First, we're going to get rid of the asset. So we want to take it off of our books. We want to credit the asset, which has a normal debit balance. So we want to credit the asset based upon the general ledger amount. This means that the general ledger amount associated with this asset will be zeroed out. Next, we want to debit the accumulated depreciation based on the general ledger amount. The normal balance for accumulated depreciation is a credit balance, so by debiting it, we're zeroing it out. If the asset is not fully depreciated, then we will want to record a loss on the disposal of asset for the difference. Note, there can only be a loss when an asset is discarded. So let's look at two examples. So let's look at a fully depreciated example. A machine costing $9,000 with accumulated depreciation of $9,000 is discarded. When accumulated depreciation equals the asset's cost, it's said to be fully depreciated or there is a zero book value. The entry to record discarding of this asset would be accumulated depreciation 9,000, machinery 9,000. Now let's look at the second example when it's not fully depreciated. How do we account for discarding an asset that is not fully depreciated or one whose depreciation is not up to date? Well, first of all, we will want to bring the depreciation up to date. And once it is, we will want to look at what the journal entry will be once we're ready to discard the asset. So in this example, the asset had a cost of $9,000 and the accumulated depreciation associated with the asset is $6,500. So first of all, we want to credit the value of the asset. Secondly, we want to debit accumulated depreciation. We can see that there's a $2,500 difference, which will be a loss on disposal. So note, there can only be a loss when an asset is discarded and only if it is not fully depreciated. Lastly, let's look at a sale of a plant asset. The sale for cash can yield either a gain or a loss. So let's look at our journal entry steps. They're going to be very similar to when we discard the asset. So first we want to credit the asset, then we want to debit accumulated depreciation. Thirdly, we want to record the cash we received. Then we want to determine if there's a difference. Then we will either debit a loss on asset disposal or credit a gain on assets disposal. Make sure, if necessary, to bring the accumulated depreciation up to date. So let's look at when we would sell an asset at book value. We're going to use the same amount of information for each one of these examples. So the book value is cost minus accumulated depreciation. So the cost of our asset is $9,000. The accumulated depreciation is $6,500 and its book value is $2,500. So first of all, we want to credit the machine, credit the asset, debit accumulated depreciation, and then record the cash. Well, we can see that 9,000, we have 9,000 in debits and 9,000 in credits. So we're in balance, and this would represent when we sold an asset for the book value. So the book value was 2,500 and we got 2,500. Now, what happens if we sell the asset above the book value? So the book value is 2,500, but we sell it for 3,000. So we're going to follow the same steps. We're going to credit the asset, debit accumulating depreciation. We're going to record the cash, but in this instance, we can see that our debits total 9,500 and our credit totaled 9,000, but we have a 5,000, we're out of balance by $500, so this would represent a gain, which makes sense because we sold it for 3,000. The book value was 2,500, so this means that there was a gain of $500 when it was sold above the book value. Now, what happens if it's sold below the book value? Well, in this instance, the cash we are going to receive is 2,500. So again, following the same steps, credit the machinery, debit accumulated depreciation, debit the cash you receive. We can see without the loss on disposal recorded that our total debits would be 8,500 and our total credits would be 9,000. So we're out of balance by $500, and that would represent the loss on the asset disposal.